Welcome to The Explainer. Today, we're going to break down one of the most important and honestly most overlooked blueprints for any company, your board of directors. Now, I know, it sounds super formal, maybe even a little boring, but getting your board structure right from the very beginning can literally be the difference between a thriving company and one that just grinds to a halt. So, let's get into it.
Okay, before we dive into any of the legal stuff, let's start where most companies actually start, with people. And more specifically, with a problem that is incredibly human and, all too common in the startup world. I want you to imagine this for a second. You've poured your blood, sweat, and tears into building a company with a co-founder. You're 50-50 partners, everything's going great until it isn't. You hit a fundamental fork in the road, and all of a sudden, you have to ask this really scary question. What happens when we just can't agree?
Look, this isn't some small disagreement about the color of a button on your website. This is a massive strategic conflict. One of you sees this incredible future of growth and expansion, and the other sees the perfect time to sell and cash out. When you're both equal partners, who gets to make that final call? This kind of stalemate, this deadlock, can bring a promising company to a complete standstill. Nothing important can get done.
And this is exactly why the board of directors exists. Seriously, it's not just a fancy list of names for your website. It's the official steering committee. It's the mechanism that's literally built to break these deadlocks and make the tough calls when founders or partners are at a standstill. So what do we even mean by board composition? Well, think of it as the rule book that spells out who gets a seat at the big decision-making table, what kind of power they have when they're sitting there, and exactly how votes are counted. And the most important thing to get is that this isn't something that just happens by accident. It's a structure you have to design on purpose. Now, while basic corporate law gives you a sort of generic foundation, the real power, the real details, are in a document called the Shareholders Agreement. You should think of this as a private contract between the owners of the company. This is where you write the custom rules that truly define the power dynamics for your company.
So, what do these rulebooks actually look like in practice? Well, they're definitely not one size fits all. You can kind of think of them as different blueprints for making decisions, and each one has its own unique set of strengths and weaknesses. Let's take a look at 4 of the most common models. First up, you've got equal representation. This is what you see all the time in those 50-50 partnerships we were just talking about. Each side gets to appoint the same number of directors. It's designed to promote cooperation and partnership, but as we already saw, it comes with that one huge built-in risk: deadlock. If you can't agree, you're stuck. Next is majority control, and this one is super simple. Whoever owns more than 50% of the shares controls the board. Simple as that. This is great for moving fast and making quick, decisive choices. The downside? Well, if you're a minority shareholder, you can easily get ignored or overruled. And that's exactly why those shareholders will negotiate really hard for specific protections. Then you have the founder-led board. This is where the founders cut a deal to keep control over who sits on the board, even after they've sold off so many shares that they no longer own the majority. It's a fantastic way to protect the original vision, the soul of the company. But, and this is a big but, investors will want a trade-off. They'll demand a list of powerful veto rights on huge decisions, like selling the company. And finally, there's the balanced board. This model brings in independent directors, people who aren't tied to any one shareholder group. Their job is to be the neutral voice of reason, to bring in outside expertise, and to act in the best interests of the company as a whole. They're there to make sure no single group has too much unchecked power. Okay, so let's quickly sum up the trade-offs here. Equal power sounds fair, but can lead to deadlock. Majority control is efficient, but it can steamroll smaller investors. Founder control protects the vision, but it might scare off investors who want a say. And a balanced board is great for governance, but all that discussion can sometimes slow things down. See, there's no single perfect answer. It's all about picking the right model for your company at your specific stage.
All right, so now that we've seen the high-level models, let's pop the hood and look at the engine room. We're talking about the specific legal clauses in that shareholders agreement that actually make all these structures work. These 5 things are basically the core mechanics of your board. The agreement has to spell out very clearly the size of the board, who gets to appoint directors, the rules for removing them, how voting works, and something called a quorum, which is really just the minimum number of directors who need to be in the room for a vote to count.
So let's start with board size. This is not a random number. It's something you negotiate and then you lock it into your agreement. A real-world example might specify that the board can have, say, up to 9 directors. That one number basically sets the entire stage for the power structure that follows.
And here is maybe the most crucial point of this whole thing. Owning a bunch of shares does not automatically mean you control the board. You could own 51% of the company, but if your agreement says you only get to appoint 3 out of 9 directors, well, that's the rule. What is written down in that agreement is what matters, period.
Now check out this clause. This is a real gem that offers huge protection. This line, taken right from an actual agreement, means that a majority owner can't just call a vote and kick an investor's director off the board. It's like a shield. It ensures that if you have the right to a seat, only you get to decide who sits in it. So what about tiebreakers? Well, some old-school boards give the chairperson a special power called a casting vote, basically a second vote to break a tie. But you know what? Most modern startup agreements explicitly forbid this. And why is that? Because it forces consensus. A tie doesn't mean one person gets to decide. It means the motion fails, which forces everyone back to the table to find a solution that more people can actually agree on.
Okay, we've covered the different models. We've gone through the nitty-gritty mechanics. So let's zoom back out and talk about the big picture here. Because all these rules and clauses, they ultimately boil down to one thing: making a very, very deliberate choice about the future of your company.
At the end of the day, this isn't just theory. All of this has a real, tangible impact. So whether you're a founder or an investor, you have to sit down and ask yourself, what kind of company are we actually trying to build here? And what's the governance structure that's going to help us get there?
Your board composition is really a strategic choice about which stakeholders you're trying to protect. A founder-led board is designed to protect the original vision. A majority-controlled board protects the people who put in the most capital. And a balanced board with strong protections for everyone tries to safeguard the interests of all the shareholders and, most importantly, the company itself.
And that, right there, is the key takeaway. Your board is not just a formality you have to check off a list. It is the operational blueprint for your company's future. The time to design it properly is now, when things are calm, not later when a crisis is forcing your hand. If you build it thoughtfully from the start, you'll be building a company that is truly built to last. Thanks for joining us on The Explainer.